Hey, welcome back. I mentioned a while ago when I made another video like this that gold had real chances of reaching 3000 per ounce in the future. It happened now, but not because of my reasons, those being especially rate cuts that should be amazing for gold miners in particular. However, they are still eventually coming, and with all the politics, uncertainty, trade wars and stuff, we might continue to see gold go up. I'll detail later in the video that gold actually has a unique advantage that kind of counters the classic commodity cyclicality, allowing it not only to remain at high levels for long but also even shoot up. I'm not trying to hype it, it's just economics and some psychology. You'll see the reasons throughout the video, I think especially in the Barrick segment. And something that people may not realize, but in USD terms, gold has grown around 10.5 times since 2000. That means it significantly outperformed the S&P, which has grown around 4.4 times during the same period. So gold, the slow and stable commodity, not a stock, has more than doubled all the hype and everything that fueled the S&P over what basically for a majority of us is at least our life in the market. But that was the past. Will it be the same over the next 25 years? Maybe if we get it in the down cycle, but at the same time, keep in mind that a down cycle will very likely not be the same as before. If you look at the latest all-in sustaining cost in the market, it got higher and higher as companies needed more money for fuel, energy, workforce and so on. Sure, it can fall, but the likelihood of seeing gold back to 1.2 thousand for example is very small. The median is now pretty much at like 1.5 thousand per ounce, and if it falls to let's say 1.8, you already lose like 30% of the production. Then companies adapt and won't sell the same, cut production, downsize, which we see in lithium right now. At 1.2 thousand, which we saw less than 7 years ago, you lose like 80% of the production, so even with recycling, which isn't nearly enough, you still have an unsustainable market. But if you look back then, you had an all-in sustaining cost of like 800-900 per ounce, so a significant majority of mines were profitable. So it kinda made sense to have it at 1.2 thousand. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. At the same time, we have impending rate cuts, which should also be very beneficial for gold. I said this before, but simply put, when you have treasuries at 4-5%, you lose too much by holding gold that pays nothing. At 1-2%, it's a very different story. On top of that, it also weakens the dollar against other assets as money would seek better yields. And for gold miners, that also means cheaper debt and more interest for the stocks, so it's like a triple win for them. Now, the stocks are kind of split because some are indeed pricing in the higher gold prices and potential, but some are even lower than 5 years ago, despite gold being 50% higher. Before we begin, I also want to mention that China, despite allegedly building a huge reserve, doesn't really buy that much on a global scale. Usually, with all the commodities that we've seen on the channel, China represents 40, 50 or even 80% of the total global exports in some cases, on top of producing a lot. A reason are also the sources of demand for gold, but more about that later in the video. Now let's get into the companies. To begin with Newmont, this is the number one gold miner by production that's currently undergoing some portfolio adjustments. They even talk about some logic behind higher all-in sustaining costs as gold prices increase. As you can see, some of it is due to higher volumes and more investing as the price supports it, as well as accounting standards, taxes, royalties and other costs. I don't think this is a perfect indicator about a company's potential, but rather something we can use to compare companies to one another. But they are doing some cost savings right now because it's actually one of the highest all-in sustaining costs in the market, and it's definitely lifting the overall average. As I said, they plan to do some divestitures worth around 2.5 billion this year from what they've already announced and focus on the tier 1 assets, which are actually very good. With some debt reductions on top, they say this is to set the foundation of strong cash flows ahead. They made nearly 3 billion last year, but that's actually with double the capex from 2021. That's because they had a big acquisition back in 2023 which added quite a bit of cash flows. Sure, after selling some assets but also repaying some debt this year, this might be different but should still be pretty good, potentially something around the ratio of 10 or even lower at the current price of gold. As it's pretty common, many companies use the upcycle to improve because that's when they have the money for it. Then they can maybe enjoy a couple of good years with normal capex and really shine. Financially, they are in a good position, with the current assets potentially covering the current liabilities and the debt if they manage to reduce it this year. We see a lot of property and investments and about 30.1 billion in equity on a 45-50 billion market cap. That means you pay quite a bit for the company's net assets, but there are indeed plenty of high quality ones in there, and I think now the highest gold reserves on the planet after they bought Newcrest. But as you'll see throughout the video, this isn't really that high, which makes sense in the current market with a lot of uncertainty and gold at basically all-time highs. Even after the asset sales, this company should continue to be the number one by reserves after buying Newcrest, but least in the public companies. That's about 21 years at the current rate of production. So do some exploration plus an acquisition every once in a while and they really shouldn't have something to worry about. Thanks to the Tier 1 portfolio, they pay a $1 per share base dividend and the rest is subject to the current environment. They used to pay more before, but with Newcrest and now portfolio rebalancing, it's down to only about 2.3% today. But they also do buybacks and still have about 1.8 billion authorized until October 2026. Given the price and the ratios, I guess it's an okay time for them to do that. So overall not a bad company. They bought a bunch of assets and are now finally doing some cleanup, and what's left should probably be the strongest portfolio of projects on the planet. Financials are good, production should be stable, huge life of mines and focusing on reducing the costs. Maybe in the near future they could also get back to more significant dividends or buybacks, potentially making the yield much more attractive. Again, they can make quite a lot of money and could potentially even get to 7, 8, 10% yields during this environment if they want to. Now Barrick, this is currently the number 2 gold miner on the planet with some exposure to copper as well. They actually plan to develop the copper exposure quite a bit, which I think is a great commodity to have, especially in the long term. The projects are advancing as planned and the gold and especially copper production should significantly increase by 2028 and 29 when they become operational. So from around 4.5 million gold equivalent ounces, they would get to around 6.5 in half a decade. That's not bad at all given the size and the fact that they do it naturally without an acquisition while also replacing the reserve depletion. As you'll see throughout the video, these companies usually go for consolidation, meaning buying another company rather than developing a new mine, and when they do it, it's often not even gold or a mixture of gold and something else. That has an effect on the supply and demand balance, which is ultimately reflected in the price, and a surge in demand from fear, recession, hype or whatever could push gold to even better levels. I mentioned before that gold is quite a unique commodity thanks to the sources of demand. Investing, banks and jewelry aren't rational demand, and an increase in the price of gold could result in even more demand. Meeting it through production or recycling is not happening for years because from exploration to production it's like a decade of waiting and there aren't that many gold projects in the pipeline. An exception would be China, that by the way has discovered a massive deposit very recently, but so far they are more of a buyer than a seller. The all-in sustaining cost was up due to ramp-ups, higher costs and the issue in Mali that I mentioned, but the company still managed to make 1.3 billion last year. However, that's with significantly higher capex, and if you look at the operational level, this was actually the company's best year ever after 2020, despite the issues. So by the end of the decade, with capex normalizing at let's say 2 billion plus a 50% increase in operating cash flow thanks to the new production, this company would theoretically make around 4 to 5 billion in this environment. That's actually very good for a 30-35 billion market cap today, placing them at a ratio of around 7. Financially, we see a very good position with 4 billion in cash and the current assets covering the current liabilities like 3 times. They also don't have a lot of debt and the current equity is pretty much equal to the market cap, which is very attractive. As you are about to see, this is among the best balance sheets and price-to-book ratios in the market, but at least in the medium and big companies. They also talk about this irrational discount to net asset value that's basically not including a majority of the company's mines and projects. And it's not even about the jurisdictions and perceived risk. Unhealthier companies with riskier assets are valued at much more than Barrick. They have some issues in Mali where the government had a recent change in legislation and basically wanted to increase the interest in the mines, and Barrick didn't really do that well. This is what we generally mean by riskier jurisdictions, and it's a very real political and economical risk. They even suspended operations in the mine in January this year, so it's not something to ignore. The dividend is based on the company's financial position, meaning that if they get a couple of good years where they mostly profit instead of investing, this can pay significant dividends for years ahead. They also do opportunistic buybacks, and this is overall an advantage compared to a company that does massive buybacks during the good times when the stock is expensive. Now, one thing about Barrick in particular is that the CEO might retire pretty soon. He denied retirement rumors a year ago, but nothing is set in stone. He's already 66 now, and even if there isn't a formal agreement to his tenure, I see 2028 as a potential year for something like that. That's when the key projects that he began should become operational, and it would make sense for him to leave them finished as his, let's say, legacy. Will a transition already begin by that time or after? We can know, but just keep in mind that it's something that's coming eventually. So I'd say Barrick seems pretty cheap so far, especially given the potential. I also really like the copper exposure, as higher electricity demand will also require massive infrastructure investments. I think there is maybe too much pessimism around them, and I don't think it's really justified. Again, other companies have riskier assets valued at much more than Barrick's, while the company is actually making good money while investing. And this company has some of the best mines and like the third largest gold reserve on the planet. Now, Agnico, this one quality-wise is among the best gold mining companies on the planet. This is the result of several mergers and acquisitions in recent history and is actually getting to a similar level of production to Barrick. What's very attractive about this company is that the all-in sustaining cost is very low, despite being almost as big as Barrick. 3.4 million ounces at less than 1.3 thousand per ounce is amazing, and any company would dream to have it. This is why I think that maybe in the future we could even see them merge again with Barrick, Newmont, Kinross or another medium-sized player. Even if it wouldn't be that convenient financially for the other, because this company has the highest market cap, I think anyone would vote in favor of joining them. That's also an advantage for Agnico, who can buy pretty much anyone in the market and even make a profit thanks to the valuation. They can make good money and had a record cash flow once again. They are at a ratio of like 25, which is relatively high, but that's also with higher capex. But again, keep in mind that this company is smaller than Barrick, so the natural potential cash flow is also smaller, even with a much cheaper production. I say natural because I include the projects in the pipeline, not potential acquisitions. As a result of the valuation, the dividend is also not huge, despite over 40 years of payments, but that's only a payout of like 40%. They also do some buybacks, which they want to renew in May this year, which isn't really the best approach unless they want to pump up the price and do more acquisitions. There is no reason for them to stop the M&As now, quite the opposite. Not doing them now would be such a wasted potential. They have a couple of projects in the pipeline, taking advantage of the very high quality Canadian assets that they have. And as you'll see later in the video, there are plenty of very good even neighbors they can buy. They have potentially even more than 2 decades of reserves, although a lot is measured, indicator or inferred, which have lower and lower grades of geological confidence. In case you don't know, it's a mineral reserve when you have clear feasibility studies behind it, and a mineral resource that can be qualified as measured, indicated or inferred based on how much evidence you have behind it. To get an idea, a better word for inferred would be guessed, because it's very uncertain and you still need a ton of studies to prove it. So in general, when a company has mostly inferred resources, there might be a problem. Financially, they are in a very good position, with the current assets covering the current liabilities and the long-term debt. They have quite a bit of tax liabilities, but also a ton of assets, leaving you with 20.8 billion in equity, valued at a market cap of 50 billion. That's quite expensive, but it's mostly high-quality, low-production cost mines. The maturities of the debt also shouldn't be an issue because it's spread very well, so not really something to worry about. Also, a mention about these companies issuing stock over time, because I know this is an argument in the market, it's not really classic issuing. They don't issue to pay salaries and stuff, this is issuing made to buy other companies. It has a clear effect on the balance sheet and profits, and in some cases, like Agnico, it's even a way to make money because they are valued at more than what they would add. So more shares outstanding, yes, but potentially even more cash flows and equity per share. This isn't really dilution, especially if it has a positive ratio. I guess we can compare them to Barrick since there are some clear differences. Better production cost, clear improvements over time, and smart M&As could potentially make this into maybe even the second largest gold miner by production. But they make less than Barrick yet are valued at more than Newmont. The net assets are significantly more expensive, the company is smaller but trading at a much higher market cap, and the main difference is the way this company is developed. They have projects in development, but this company is one of the most active in terms of mergers and acquisitions. Barrick didn't really do any in more than half a decade, although you can never know. They relied more on their own projects and adding new production, especially copper, and it's an overall different approach. As a result, they also have a higher all-in sustaining cost, although here Agnico has a clear advantage even without it thanks to the mines in Canada. And don't get me wrong, I get the premium for quality and the way the stock moved. This is normal. My point is that Barrick and Newmont are the odd ones. Agnico should be a $50 billion company today, maybe even more. But so should Barrick, and Newmont should probably be in the 70s, 80s, 90s even. Anyway, Agnico is definitely a good one, among the best, and if I get the chance during the down cycle, this is clearly a buy for me. Healthy, good management, potentially nice dividends at the right price, and very good quality overall. This is a perfect example of how a gold stock should behave in this environment, and the market is, I'd say, right with the current price. Now, I also want to include Franco-Nevada, even if it's not a gold miner. This is a royalty and streaming company, meaning they give money to other companies that actually do the mining in return for either a percentage of the future production or the right to purchase at a fixed price. The idea behind this is you get a much lower risk company that finances the mining sector without that much exposure to the volatility of the commodity. They are part of many gold miners' day-to-day operations, and it's usually one of the go-tos when they need money, especially for expansion, M&As, projects and so on. You'll notice some companies even in this video that have pre-sold gold on the balance sheet as a liability, and they are kind of like a bank in the industry that accepts future production instead of cash. They have a portfolio of 432 assets globally, including stakes and claims in several popular mines and a lot of exploration. We see a very high margin of 56% because they don't really have that many costs. You can see on the screen an example of how the company operates. This company needed some money to revitalize a mining complex, so Franco-Nevada provided it in return for some equity, a nice yielding loan and royalties for the duration of the mine. You know, a bank could probably not even give Discovery, a $500 million market cap company, some hundreds of millions in financing. The loan is senior secured, by the way, so even if the company goes bankrupt, they should still have good chances to recover it. But my issue with the whole royalty and streaming sector is that they don't make that much money. Sure, amazing margin, but very tiny revenue for a 30 billion market cap. Barrick made in a year full of investments like 3 times more than them on the same market cap. Again, this is a low volatility business, so why would you pay 70-80 times the cash flow? For this type of company, the revenue is the same as in 2020, nothing really changed. Financially, we see an exceptional position with the current assets like 5 times above the total liabilities. But again, there is 6 billion in equity on a 30 billion market cap, and what they have is very well noted on the balance sheet, so this is what you get. What's good about them is that this is the type of business that can really compound. By 2029 they see plenty of potential to improve the attributable production, so all they need is companies needing money. I think that can be even better from a business point of view if gold prices fall, because that's when a company like this is really needed and they can also ask for better yields. But that also comes with potentially more risk, although if they are careful and selective, which they are, it should be an overall net positive. Despite increasing it over time, the company pays a 1% dividend, which actually represents a pretty high payout ratio. And that's ultimately my conclusion. Not a fan of the price, although the company itself is very good. However, if I manage to get one of them during the downside, when I could maybe get a 4% yield plus leverage on gold, it would be much more interesting. It would basically become a treasury with potential to grow plus the volatility of gold. This is a general conclusion, and it's the same for all the other streaming and royalty companies. Now Alamos, this one is probably the best gold miner when it comes to quality, at least in the bigger and more popular companies. They keep breaking records in everything, especially after buying a neighbor, and this is the reason behind the price. This is how the market expects a gold miner to look like in this environment. We see a very good and potentially much lower all-in sustaining cost combined with potential to grow organically. They expect a roughly 24% growth in production by 2027 and even more than 60% in the longer term, all based on the current projects. Not only that, but as I said, the gold they add should be even cheaper to mine, dragging the all-in sustaining cost down. On top of that, the average life of mine is around 18 years, so this one, if I get the chance to buy it at a good price, is definitely a strong buy. Depending on the price of gold, they see $500 million in cash flows by 2027. At the current price, it's maybe even 600 million, with potential to grow much more in the long term. A year ago, despite the very high capex and thanks to the acquisition and developments, they made around 272 million, more than doubling year over year. But at the same time, right now that's pretty much a ratio of 40 or potentially less than 20 by 2027. So yes, huge potential to develop in the long term at amazing prices and very little downside for the company, but the stock is pricing in all the potential they have. Sure, higher gold prices will make them go up even more, but the downside, if they underdeliver or the price of gold falls, is also very significant. You know, go to 2000 per ounce and that's half of the cash flow gone, or even negative before 2027. Financially, they are in a good position, with the current assets covering the current liabilities and not a lot of debt. We see an increase in debt because they've recently drawn 250 million from their credit facility, which I think is actually provided by Franco-Nevada. Again, these companies are actually everywhere, even if we may not realize it. So healthy and they can repay it easily, but again, you have to pay like 3 times what you get. Sure, amazing low-cost assets with huge potential, but still very expensive. And another advantage that smaller companies have is how easy it is for them to develop and create synergies. Look at what the merger with Argonaut did. Something as simple as sharing the mill, equipment, management and stuff could create like $500 million worth of synergies. A company like Barrick, for example, would barely fill $500 million over 20 years, so they need to get into much bigger buys that may not be so efficient. However, with all that potential, low risk and very low production cost, Alamos is definitely a buying target. Potentially 1 million low-cost ounces per year in Canada is a lot and literally gold for any company. Or they could use the high valuation to buy other neighbors and continue to improve significantly. So definitely a company to pay attention to in my opinion. Now B2Gold, this company has 3 projects operational and another 3 in development. We can see a big jump in guidance of like 25% compared to last year because they expect both the Canadian project and the ramp up in Mali to start producing in the second half of the year. Then in 2026 it's probably another similar jump when they are fully operational. And then in the late 20s the project in Colombia should also become operational, so this company has real potential to basically double the production by the end of the decade. The all-in sustaining cost is higher now due to some logistic issues plus higher costs, but the projects are advancing as planned. Not only that, but even now with a quote-unquote bad year where production was affected and they had some strikes, they almost broke even with a significantly higher capex. You know, in the near future, when the capex fall by, let's say, 300 million plus a 40% increase in production, they would basically make like 700-800 million at the current price of gold. For a market cap of 3.5 to 4 billion, that's a ratio of around 5, and again, that's 40% more of a year that didn't run at full capacity. The market's main issue is that they rely on the mining complex in Mali, which has political risk, as we've seen with Barrick. But the projects in Canada and Colombia should significantly diversify and improve the company's political exposure, so there is kind of another catalyst from this. Financially, we see a very good position, with the current assets almost covering the current liabilities plus the long-term debt. There is about 3 billion in equity now, despite a significant adjustment a year ago and an increase in liabilities. So even with all of that, they are nearly at a price-to-book ratio of 1 and were there recently. And this is something to remember for every other company. This is why I prefer the price-to-book ratio to be as low as possible, because if you go for a company with a ratio of let's say 2, they do some adjustment, which is common, and the ratio suddenly gets to 2.5, then you might realize that you are overpaying quite a bit for what you get. And you would see this as an issue, especially in a bad environment. Now everything is great for everyone. Overall, I like B2 and it's actually one of the latest additions to my portfolio. Among the best financial positions in the industry even after the recent changes and projects, and the potential is definitely there. I think the market is maybe giving the Mali risk a bit too much worry, and right now they are in a much better position than Barrick in Mali, for example. If the projects continue and everything goes as planned, this would be too cheap to ignore in my opinion, while the risk would be reduced. I think it's more of a value or a turnaround play at the current level with bonus potential from gold. I know they've been promising things over and over like all the other gold companies, but I think it's either they prove it in 2025 to 26 or it's indeed a bad company. Of course, it depends on the price of gold as well. You can see on the screen some of the most important indicators for comparison. There are some common trends and you can even put them into two categories. My picks at the current prices would still be Barrick and B2, and I actually own some of them. I think these two, given the upcoming in and outside factors, offer the best opportunity right now for me. Usually I wouldn't really buy into a commodity stock when the commodity is at all-time highs, but gold right now seems a bit different with everything going on. You know, Trump, trade war, actual war, rate cuts, recession and so on all impact the demand for gold. I think it's a good commodity to have some exposure to, especially through high-quality mining companies. For that I'd love Agnico or Alamos, but not at the current prices. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.